Naila Richardson, Chief Economist at ADP, as well as Laura Cooper, Senior Investment Strategist at BlackRock. So thank you both for joining us. Laura, how are we doing? Are we surviving the week? I mean, it was pretty volatile. It was like a bit of a roller coaster. And again, it's unclear what crystallized the fears in the markets.
Well, I think certainly the price action around this rates repricing towards this new macro regime of higher inflation has really been the most pronounced move. And I think the question that we've been facing from clients is, where is this endpoint where we're going to start to see buyers coming in? And we really question the fact that, rates are likely to go even higher above that 5% mark, because if we look at the term premium, it's only positive about 30 basis points now based on some models. There is scope for it to go higher, even if we see bouts of volatility as some dip buyers return.
I mean, the market sometimes is ahead of the curve and sometimes it's really behind. So we have a number of stories saying, look, this is what breaks if we stay at 5% for a longer time, maybe a much longer time. I mean, what happens at 5.5 or 6%? Is there something that you need to sell off or take stock of right now?
So clearly the U.S. economy cannot withstand rates at that level, particularly when the moves have been driven by real rates and the fact that we do have that 10-year rate with a 2% handle. We're already seeing that in terms of a slowing in consumer discretionary spending. That's likely going to be the key trend next year. If we think about mortgage rates are sustainably already above 7%, mortgage applications for new homes have fallen to multi-decade lows. So we are going to see the consumer come under pressure in this backdrop of tighter financial conditions. And that really raises the question of how long can the Fed keep rates in restrictive territory? It's less about another 25 basis points or so. It's when will they actually ease policy next year?
Now, this is the million-dollar, trillion-dollar question, but in the meantime, what happens to credit? What happens to actually households having to repay debt in the U.S.?
Well, let's start with the labor market, because what's different about a Fed tightening cycle is that we still have a strong labor market. So there is some support for the consumer in the U.S. When it comes to the credit market, obviously borrowing costs have gone up. You've seen housing come to a virtual standstill, not because there's not demand out there. There's no inventory. Most homeowners are locked into a 3% interest rate, or definitely below 6%. So it makes no sense right now to financially put your home on the market and trade to something else. That's what's brought the market to a standstill, not the lack of demand. So the consumer, yes, it's slowing, but it hasn't gone to a standstill yet in a way that tips into recession. I think that's an important point.
Now, so yet, and
yet.
The yet is extremely important, because
Right.
if you look at hiring, so the labor market is strong, but they're not hiring that much, especially in the private quarters.
Well, large firms aren't. If you look at the ADP report, which is about 20% of the U.S. workers in the private sector, what you see is an interesting dichotomy between small firms and large firms. Large firms hired aggressively last year. They started pulling back, and we saw those announcements of layoffs late last year, early this year. You're still seeing weakness in large firms, but small firms have been hiring, and that's very interesting, because you would think that smaller firms were more sensitive to the rate environment we're in now. They're not showing it in their hiring yet, because they're still trying to get their headcount up and grow their businesses, and that is a good important signal that's often missed in the markets. These small firms aren't part of the market, so it's easy to overlook them.
Yeah, that's such an interesting point. All right, this is one of my favorite times of the early mornings, and it's the big number. So every day we choose a big number. Thank you, Dan Tillis, for always coming up with an interesting number. Now, this is the gap between the survey and the whisper estimates for today's U.S. jobs report. And the difference between that is 20,000. So if you're wondering what the whisper is, it's basically the sweepstake that Laura does at the office, right? That's how we calculate the whisper. I mean, how important is this job? I know every month it's important, but again, I feel like it could be a watershed potentially moment for the markets.
So I think we're going to need to see a significant deviation from that consensus, even beyond that 20,000 whisper margin, because ultimately this is, a market that is looking for, is the bad news going to be good news? And could we start to see more of those rate cuts that were previously priced out start to be priced back in? We will be watching, though, the unemployment rate and labor force indicators beyond just the payrolls print, because I think clearly that trend of hiring is slowing. The unemployment rate, what we're looking for is the labor force dynamics around, are we going to see more workers return to the workforce? Because it's really been that structural shift where workers have left that have kept wages elevated. We're expecting average hourly earnings to tick higher again today. That's a crucial input into this overall environment where inflation is likely going to be higher through next year and over the medium term.
And Nela, so first of all, I do love this because probably every office around the world is, putting sweepstakes on rugby matches and football, and here we are with the non-farm payrolls. But how quickly, or what's the earliest that you think the Fed could cut interest rates?
I think we're a ways from a cut. If you look at
not next year,
Maybe, but not in the first 3 months of next year, which is what some in the markets were thinking, that this would be an over and done a rate hike by now. But if you look at the labor shortages that you're seeing that are structural in nature, it does keep a floor on wage growth. We are seeing wage growth decelerate. I think that's the number to watch rather than the jobs number, which that 20,000 whisper, that's not even close to the revisions we've seen coming out of these numbers before. But if you look at wage growth, it's been a steady decline. That's great, but it's likely to stay inconsistently higher with 2% inflation. And that is the rub for the Fed. All the numbers are moving in the right direction, but they're not moving fast enough back to that 2% target.
Yeah, Laura, how quickly do you think that the Fed can reverse course? I mean, I know it depends on the strength of the economy, it depends on energy prices, but do you push it back?
So at this point, we are penciling in a Q3 rate cut next year. And I think the crucial thing is that in the near term, markets have priced out the next rate hike if we do see a strong print come in today. So there is scope for the move that we have seen in yields to extend and even reverse more of this bull steepening rather than the bear steepening. And I think that's really crucial to watch for around the next recessionary indicator, because timing that downturn has really been the most challenge facing strategists and commentators.
All right. So thank you both for joining us. Nela Richardson, Chief Economist at ADP, Laura Cooper, Senior Investment Strategist at BlackRock, both stay with us. Also, Bloomberg has learned that ExxonMobil is in talks to acquire the shale-focused Pioneer Natural Resources. Now, the deal is huge because it's worth some $60 billion, potentially the largest acquisition of the year. It would make Exxon the top producer in the most prolific U.S. oil basin, talking shale oil. It would also make one of the largest oil companies in the world even